Welcome to A Canadian Investing in the US, a podcast and YouTube channel focused on Canadians buying real estate with host Glen Sutherland.
Welcome to another episode of Canadian Investing in the US. This week, my guest is Jose Jafferji. Jose, let's start by giving everybody a bit of an intro to yourself, and then we'll chit chat.
Sure. Yeah, no, thanks for having me. I appreciate that, Glenn. I started investing in real estate back in 2007. Bought a couple of properties, and then we started a company called Savvy Real Estate Group, my wife and I. And now we've kind of evolved into a more private equity model where we invest in apartment buildings, primarily now so in the US market. However, we were also buying properties up until like 2 years ago. We were buying in Ontario market as well. So we have a total of 150 units in Ontario, and then we have about 450 units in Southeast United States, and specifically in Atlanta. And those were we use the syndication model to raise equity and to partner with other investors to get involved in larger projects.
That's awesome. Yeah, I'm just starting to get into the same thing. It's a good way to go. So maybe I'll poke you in this direction. So you went from doing Ontario and switching to the US. But whenever I did the switch, I was doing more residential, and you're doing it from commercial from one to the other. What's the differences? Why go down that path? Why not continue with Ontario?
Yeah, no, great question. I mean, as you know, Ontario has some of its challenges. So in terms of landlord friendliness, it's definitely not landlord friendly. So, we have rent control, which is obviously puts in it puts in a lot of pressure for landlords to make our numbers work, right? Especially when you're buying an apartment building, you don't get that turnover that you're expecting to boost your income, to implement your business plan. So you kind of almost, it's an unfair system. So I got really frustrated, my wife and I, and we decided to, let's look for another alternative market, which it could have been another place in Canada, like Alberta. Yep. However, we found that the US 10 times bigger population, a lot more opportunities, and we felt that it was a larger opportunity to scale, right? We can go tap into multiple different markets, implement the same strategy. We have a much larger deal flow, and you know what, like financing wise, you can get interest only loans, which obviously gives you a much larger cash flow. So the the three top things were landlord friendliness, no rent control, and definitely higher cash flows is what kind of attracted us to the United States.
Have you found any differences in like cap rates that depending on which markets you're going into, or like price per units from going from Canada to the US?
Oh, definitely. Like if you compare Ontario to any kind of Southeast United States, I would say it's about half the price, right? And regardless of, leave the exchange rate aside for now, but because you're getting the same rents in the US dollars, so literally it's the same thing, right? You can purchase something for about $120,000 in the US, while in Canada you're going to be paying double, right? The rents are definitely going to be much lower. So in terms of implementing your business plan, which is to renovate your units, increase the rents, it's going to take you much longer, right? To do that. And so when we, specifically for us in our company, when we decided to go down the private equity path, we wanted to make sure that whatever we projected for our investors is what we're going to be able to actually come to fruition. We're not, obviously, nothing goes 100%, but we're at least able to, on a yearly basis, know, okay, we want to renovate 2 units per month. Can we do that? Ontario, you're stuck with, hey, it's kind of a shot in the dark. We've
Whenever
had
they
some
leave.
great success with
Yeah.
some buildings, while others we're stuck with tenants that no matter what you do, they're not going to leave. So that's kind of the main reasons why we switched that focus. And to answer your question about the pricing, it's just definitely much cheaper. What we found in the Ontario market is that there's very few deals, and there's a lot of capital chasing these deals. So pricing, no matter what, gets inflated. And that's just the nature of the supply and demand here.
So going down to the US, when you're starting this and doing like commercial financing, did you find it any lending difficulties or anything like that, or did you bring in a sponsor? Or how did
Yeah.
you pull off
Yeah,
the?
with the larger deals, like we purchased smaller properties, which would be, residential side, would be
Yeah.
30% down, but which we would be able to qualify. But for the larger deals, you gotta have three things. You gotta have the high net worth, so which is equivalent to the loan amount, experience in that market, and liquidity. So you need to have that at least 10% liquidity. For Canadians, the requirement is even bigger. So we actually had to have a sponsor that was a key principal that would sign off on the loan.
Yeah, that's what I'm usually finding too, and that's what we're hiring out as well.
Yeah.
It seems to be the way to go. Plus, you have an American then on there to help everything.
That's right. Yeah, it definitely makes things a lot easier. While we're still building our track record in the U.S. with our own properties and our own holdings, so I'm kind of doing some smaller deals simultaneously, just so that we can build up that track record personally as well as as a general partner.
Cool. And we're in a crazy market right now, a little bit different. Cap rates are going up, at least in some markets, which means the prices are coming down. Are you still buying? Are you waiting for a bottom? What do you see the opportunities in this kind of market?
Yeah, we're definitely still open to we're actively looking,
Yeah.
but we're also very, very, very particular about what we're going to be buying next. We're going to be super conservative on our debt assumptions, our future projections, just because of the nature of the market. So we're definitely not sitting on the sidelines. We are actively looking, but it has to fit our sandbox on exactly what we're looking for. So right now, I would say, generally speaking, there is a kind of a discrepancy between what buyers are willing to pay, and what sellers are looking for the property. So there's still some disconnect because of the higher rates. We have to as buyers, we have to make sure that we account for the higher rates, which means a little bit of a lower price. So
Yeah.
so deal flow is very low right now, especially in Q1 of this year so far. I think that's going to change probably in Q3, Q4 of this year, when I'm projecting the rates to start dropping. So hopefully I'm right.
Yeah, I'm thinking the same thing too, and I'm seeing that. Yeah, this exact same thing. Just to regurgitate what you said, but the market has changed, but not the seller's mental what they think that properties are worth. And some aren't, unless they're desperate, they aren't willing to actually give you what you're looking for in the market. That's why I asked that question, because I'm finding, like, where I want to underwrite at, it's tricky to find people who want to do that.
Yeah. No, it's especially with commercial properties, only people that really need to sell are putting it on the market, right? Or talking to brokers. But other than that, as these sellers are pretty sophisticated themselves, so they know that this might not be the right time to sell, because they may get a little bit more probably next year, right?
Yeah. So what does your business look like? Do you travel back and forth to Atlanta all the time? Like, what does it look like right now?
Yeah, I would say when we just closed on a property in Atlanta in December. So I was there for a kickoff meeting with our property management and construction staff, as well as the on-site, just to kind of get things in motion.
Mhm.
But besides that, I probably travel to Atlanta or check up on the properties physically about every quarter.
Yeah.
Other
have a
than
trust
that,
team. Yeah.
I mean, we definitely are very much involved. Like we have a call at least 2-3 times a week with the on-site as well as our own team. So we're very much involved, and since the acquisition of this property, we are there's a lot of work ahead of us. So in cleaning up the tenant profile and improving the management efficiencies. So right now it's still a stabilization period, so very much asset management heavy, and which is going to be a very critical, especially in moving forward, because we cannot just rely on the market and rent growth that we've had over the last several years. It's going to be now asset management is going to be critical moving forward as the market is softening. So really got to pay attention to your property manager, make sure they're executing on what your business plan is. And sometimes it's a lot of babysitting them, is so unfortunately.
Yeah. So you just closed in December. So with these multifamilies, there's usually a long lead up of timelines, right?
Yeah.
So I'm guessing that you bought when you were originally putting this property under contract, the market was different, right?
Absolutely. So to just give you an example, we got this under contract in end of June.
Yeah.
And typically, a normal closing time would have been like 90 days or so, even for a larger commercial property. But this one took like 6 months, and the reason is because we had to retrade twice, which the seller was willing to work with us. So we were able to get 2 price reductions. And then just to account for the higher lending costs, right?
Exactly. Yeah.
So, and then the other major part was raising the capital for this property, which was definitely a challenge because a lot of investors were fearful of what the market is changing so rapidly. So, we had to. It took much longer and to raise the capital, right? So yeah, definitely. What in that time frame, what happened was the property manager, the previous property manager and previous owner kind of became very passive about everything. So they let go of a lot of things. They were putting in tenants they shouldn't have been putting. So now we gotta,
It doesn't matter to them anymore. That's under contract.
Exactly. So they know that the sale is going through. We had actually $1 million hard money with them, so it's not something that we were gonna walk away from.
Yeah.
So they knew that they didn't really care as much. So unfortunately, we're cleaning up that mess right now, to be fully transparent.
Oh, that's it. Oh, that's one of the scary parts of these slow closes, right? And once your money's went hard, you're kind of obligated. But what obligation does the seller have to that? Like if they let the operations just slide a bit, would you just ask for another price reduction if it all of a sudden the vacancy rate went way up or anything like that?
Yeah, so I mean, we were obviously getting reports on what was happening, but it's sometimes they manipulate things, right? They manipulate the data. Like, so physical occupancy was still up, right? Because that's what our lender wants.
Yeah.
So physical occupancy, as long as over 90%, the lender is fine there. But the economic occupancy, which means that tenants that are paying the rent was much less, right? So in like, especially for example towards the end, they would be putting in tenants that are not even qualified to be financially qualified. So they weren't screening the tenants properly. So we didn't know this because it was like 2 months later when we closed.
Yep.
It was too late, right, for us to actually catch those things. They're like, okay, yeah, there's a couple of delinquent tenants now, so what, right? Not a big deal. It's something that to expect. So yeah, it was definitely a learning experience. So that was our second deal in Atlanta, and as a larger multifamily syndication. The first deal we closed on was actually we got under contract end of 2021. We closed in February of 2022, and that has definitely been a big home run for us so far. So
you locked in. I'm guessing when people say it's a home run and they bought it a year ago, you probably locked in your term. You didn't do any bridge financing or any of that funny stuff.
No, we did still go with bridge financing. However, we bought what's called a rate cap. So there,
buy it. Good.
Yeah, so that basically protects us against any future rate hikes.
Yeah.
Which is we've been kind of in the money on that rate cap. So we are getting paid like an insurance would.
I've heard of a lot of people cheaping out and not buying that and then getting themselves into a lot of trouble.
Yeah, no, I definitely would recommend it. I mean, most of the lenders require it that you purchase it because they want to make sure. But yeah, just in terms of the price basis that we got that first deal, it's some of the comparable sales have been like 20% more. So we know that that's going to be worked out really well. Still a lot of work to be ahead of us, but our original plan was to sell that in 5 years, refinance in maybe in like 3 years. But instead of refinancing, we might decide to sell earlier, depending on how the market goes.
Okay. And then what is your business plan for these? Like, would you maybe instead of me guessing?
Yeah. I mean, business plan is in a nutshell, it's pretty simple, right? We want to raise the net operating income, the net income on the property. So which means that we want to increase the income and reduce the expenses. So we usually renovate units. Typically, we want to renovate about 50 to 75% of all the units. Raise it to market rents. So we would get typically about we spend about, let's say, $7,000 to $9,000 per unit. We get about a $300 rent bump. And then and on the one that we just closed on in December, we're adding washer dryer there's already connections, so we're adding washer dryer units, which will give us another $50 a month. And then we're implementing water conservation to reduce the water usage. So that means just like low flow toilets, reducing the water bill essentially. And then kind of taking care of a lot of different maintenance. Or there's some leaks and like roof drainage issues. So overall, our plan is to improve the quality of the tenant profile in the property, as well as increase the rents at the same time. So yeah, essentially, our goal is always to double the investor's money in that roughly 5-year time frame.
That's awesome. Yeah, so nice 20% return at least, or if you did.
And then what I can tell you about multifamily, right, specifically, or commercial properties, is that unlike Ontario, right, the other big aspect investing in the US is that you can charge for, besides the base rent, you can charge all these ancillary fees, right? So you're charging them pet fees, charging them trash fees, application fees. Sometimes we charge them also like storage fees. And so all of this is on top of their rents, and then we charge them what we call RUBS, or ratio utility billings system, which is essentially charge them for utility usage. As a set fee for depending on the size of the unit. So that is all on top of the rent, which Ontario, you can just you can't charge all these extra stuff, right? So you get a lot of other income.
Yep.
And, just for your listeners' sake, $1 per month in increase in income, you multiply that by 12, apply a 5% cap rate to it, is going to give you $240 in value. So every $1 increase is giving you $240 in value. So that is why multifamily is, and just commercial real estate in general, is so powerful, because of that multiplier effect.
Oh, definitely. Definitely. Jose, if any people want to track you down, they want to get a hold of you, where do they find you? What's some of your spots?
Yeah, so definitely give me a follow on Instagram. It's Jose Jafferji. Check out our website, savvyrealestate.ca. It's savvy, SAVVY, realestate.ca. And we also, my wife and I, run a podcast called the Savvy Real Estate Investor Show. Check that out as well on iTunes. Yeah, pretty much it.
Awesome. Well, Jose, I appreciate you coming on the show. Appreciate you sharing your business plan, how it's all going. I think there's a lot of value here for the listeners. Thank you.
No, I really appreciate you having me.